All right. So the AI build out is running into a completely different constraint, and that is electrical power, not computing power, but actual electricity. Because these enormous AI data centers don't just need GPUs, they need hundreds of megawatts and eventually gigawatts of reliable electricity running 24 hours a day. And that's why we've already started following power in season 2 of the AI Factory. We've looked at companies that can generate more electricity. We've looked at companies that can help distribute that electricity inside these massive facilities. But there's a major step in between. You can build all the power plants that you want, and you can add natural gas turbines or nuclear reactors, or you can also deploy fuel cells. But if you can't actually move that electricity from where it's generated to where the AI data center actually needs it, then you got a problem. And we're starting to see evidence that this isn't just some theoretical problem 10 years from now. The electrical grid is already showing signs of stress. In PJM, America's largest electricity market, transmission congestion costs reportedly reached roughly $6 billion during the first half of 2026. And that increase is about 43%. Think about what congestion actually means. Electricity may exist, the demand definitely exists, but the infrastructure connecting the two isn't always sufficient. And AI is adding enormous new loads to a system that's never designed for dozens of giant data centers, suddenly asking for hundreds of megawatts or even gigawatts of additional electricity. We're even starting to see companies consider building more power directly on site because waiting for enough utility grid capacity can take too long. And that changes the AI investment story because the winners from this build out may not only be the companies producing electricity, there could be another group of companies sitting directly in the middle of this bottleneck. The companies that build transmission lines and the companies that construct substations, the electrical contractors connecting enormous new loads, and the companies manufacturing the equipment that make the grid work. And that's where today's stock hunt actually begins. We're going one step deeper into the AI power trade. We're not asking who can generate more electricity. We are asking who makes money moving that electricity to where AI needs it. And to answer that question, we first need to follow the money. So when you start looking at how much money may need to be spent upgrading America's electrical infrastructure, the numbers get enormous very quickly. U.S. investor owned utilities are planning roughly $1.4 trillion of capital investment over the next 5 years. Now, I want to make something very clear. That is not $1.4 trillion of AI spending. Utilities already needed to replace aging infrastructure. They already needed to improve grid reliability. They also needed to connect new generation. And they already needed to expand transmission capacity. But now we're layering AI and massive data center electricity demand on top of all of that. So AI isn't creating the entire grid modernization cycle, it's accelerating it. And that's exactly the type of situation we're looking for in the AI factory. Because once that capital starts moving, somebody has to capture it. And here's where today's three companies come into the picture because they don't all make money from this build out the same way. And the first company is Quanta Services, PWR, power, ticker symbol. Quanta is the heavyweight. When utilities need massive transmission lines, substations, and major electrical infrastructure built, Quanta is one of the companies capable of taking on those enormous projects. Next is MYR Group, MYRG stock symbol. MYR operates in transmission and distribution too, but it's dramatically smaller than Quanta. It also has commercial and industrial electrical operations that put it directly into markets like data centers and mission critical infrastructure. And then finally, there's Hubbell, HUBB. Hubbell gives us a completely different way to play the same theme. Instead of primarily building the transmission infrastructure, Hubbell sells many of the electrical components and products that utilities and contractors need to build and maintain the grid. So we have three different potentially capture the same wave of spending. So we have three different ways to potentially capture the same way of spending. One company builds an enormous scale, one is smaller challenger, and one sells the picks and the shovels. And there's one more distinction that's important before we start comparing these companies. I am not going to call Quanta, MYR, or Hubbell pure AI stocks. They are not. These are electrical infrastructure businesses benefiting from a much broader modernization of the power grid. But if AI data centers dramatically increase electricity demand, and if utilities need to build more transmission, if more substations are constructed, and if billions of dollars of additional electrical equipment have to be installed, then AI becomes another major force pushing money towards companies like these. And now we got to figure out which company is positioned to capture the most value from that spending. Because our first competitor isn't some small company hoping this opportunity eventually arrives. It's already sitting on tens of billions of dollars of work. And it may be one of the most important infrastructure companies in the entire AI buildout. And that is Quanta Services. All right, Quanta Services. Stock symbol is PWR. And when I say Quanta is big, I mean big. This is a company with a market capitalization of roughly $90 billion market cap. And its business stretches across electrical power infrastructure, pipelines, communications, and major energy projects. But electricity is increasingly the center of the story. In the second quarter of 2026, Quanta generated $9.56 billion of revenue. That's roughly 41% year over year growth. Adjusted earnings per share came in at $4.24, well ahead of roughly $3.31 Wall Street had projected. And management raised its full year EPS guidance to between $16.45 and $16.95. Those are impressive numbers, but there's one number that really tells you what's happening underneath the surface, and that is the backlog, $53.4 billion. And that is a record project backlog. That backlog has grown dramatically from roughly 35.8 billion from a year before. And that tells us something very important. Companies simply are not simply talking about spending money on the grid. A huge amount of work is already being awarded, and Quanta is capturing it. But then I found a project that makes the AI connection much easier to understand, because Quanta isn't just benefiting indirectly from utilities preparing for future electricity demand. It's already involved in infrastructure designed specifically around an enormous data center load. NeSource has selected Quanta to help deliver infrastructure capable of supporting roughly 3 gigawatts for a major data center campus in Indiana. 3 gigawatts, to put the scale in perspective, we are not talking about connecting another office building to a grid. We're talking about enormous new electrical load that requires an entirely different level of infrastructure. And Quanta's role goes well beyond simply putting up a few transmission towers. The project can involve generation infrastructure, battery storage, transmission, substations, and underground electrical systems. And to put it in perspective, 3 gigawatts is roughly equal to around 300,000 houses getting electricity. And this is what makes Quanta so difficult to ignore in this competition. And this isn't Quanta's only major opportunity. Quanta's also has a strategic relationship with American Electric Power, or AEP, around major high voltage transmission infrastructure. And these projects are becoming enormous. When utilities need to connect new generation, expand transmission capacity, or bring huge new loads onto the grid, there aren't unlimited companies capable of executing projects at this scale. And that's Quanta's advantage. It's got the workforce, it has engineering capabilities, it has the equipment and the experience. And increasingly, it can handle multiple pieces of the project instead of forcing the customer to coordinate a long list of different contractors. So after looking at Quanta, I understand why the market has become so excited about this company. If America is entering a massive electrical infrastructure build out, Quanta looks like one of the most obvious beneficiaries. But there's another side to being the obvious winner. Quanta has already become a $90 billion company, and investors already understand the story. And eventually, we're going to have to ask how much we're being asked to pay for all this growth. We're going to save that question for later, because before we decide whether Quanta is the best stock, I want to look at a company doing some of the same work at a fraction of the size. MYR Group, stock ticker symbol is MYRG. But unlike Quanta, MYR is not a $90 billion company. Its market capitalization is at $4.7 billion. And that's roughly 1/19th the size of Quanta. And whenever we're looking at a huge secular trend like this, company size matters. A $90 billion company can absolutely continue growing. But if billions of dollars of additional spending starts flowing through a company worth less than $5 billion, it can potentially have a much larger impact on the business. And of course, that only matters if MYR is actually growing. And right now, it is. Second quarter revenue reached a record $1.08 billion. That's up 20% year over year. Earnings per share reached $3.17, beating expectations of roughly $2.62. And just like Quanta, MYR is seeing its future workload expand. Its backlog reached an all-time high of approximately $3.16 billion backlog. And that's roughly 20% higher than a year earlier. But MYR gives us another interesting angle. Its business is divided into two major areas, and the first is transmission and distribution. That's the obvious grid play. MYR helps construct and maintain the infrastructure utilities needed to move electricity around the country. Here you see transmission and distribution. And that's the obvious grid play. MYR helps construct and maintain the infrastructure utilities needed to move electricity around the country, as just stated. But its second segment is commercial and industrial, which is part of the data centers. And that puts MYR inside projects involving things like hospitals, manufacturing facilities, mission critical infrastructure, and importantly for us, data centers. And now I want to be careful here. MYR does not tell us that 20 or 30 or 50% of its revenue comes from the AI data centers. We do not have that number, so I'm not going to invent one. But management does specifically identify data centers and mission critical infrastructure as markets within these businesses. And MYR has been expanding those capabilities. Its acquisition of Valley Electric and Comet Electric added additional electrical construction expertise, including more exposure to mission critical and data center projects. And that gives MYR two potential paths in the spending cycle. Into this spending cycle, it can benefit when utilities expand the grid, and it can potentially benefit again when enormous commercial customers build the electrical infrastructure inside these facilities. But there's another piece of MYR story that I really like, and it's evidence that major utilities are willing to give this smaller company substantial long-term work. An MYR subsidiary won a 5-year design build distribution agreement with XCEL Energy that is expected to exceed $500 million through 2029. And for a company MYR size, that is meaningful. It highlights something we're going to come back to when we talk about competitive advantages. Utilities don't hand hundreds of millions of dollars of electrical infrastructure work to a contractor simply because it submitted the cheapest bid. Reliability matters, safety matters, execution matters, and relationships matter. So now the competition has changed. Quanta clearly has a scale advantage, and it has massive projects and enormous capabilities and tens of billions of dollars in backlog. But MYR doesn't have to become Quanta to create significant shareholder value. It's starting from a much smaller base. And that is why MYR may be more dangerous in this competition than it first appears. The question is whether being smaller gives MYR greater upside, or whether Quanta scale ultimately gives an advantage that MYR simply cannot overcome. But before we answer that, there's a third company we got to investigate. And this company doesn't primarily make its money by sending thousands of workers out to build transmission lines. Instead, it sells something nearly every electrical infrastructure project needs, and that is the picks and the shovels play. And the last company that we're going to review today is Hubbell, Hubb, stock symbol. Hubbell has a market capitalization of roughly $25 billion. The market cap, $24.8 billion, putting it right between Quanta and MYR in terms of size. But Hubbell is not trying to be another Quanta. It does not need to be, because when utilities spend billions of dollars building transmission lines, upgrading substations, and expanding the electrical grid, they need an enormous amount of specialized equipment to make all that infrastructure work. And Hubbell makes that equipment. We're talking about products used throughout the electrical system: connectors, insulators, arresters, utility components, grid automation equipment, and other products that help utilities safely move and manage electricity. So think about Hubbell as our picks and shovels play. And if Quanta and MYR are out there helping build the gold mine, Hubbell can make money selling some of the equipment everybody needs to build it. And right now, demand is strong. In the second quarter, Hubbell's utility solutions business generated roughly $1.03 billion in sales. Within that business, grid infrastructure sales increased by 12%. And Hubbell Electrical Solutions segment is also benefiting from another piece of our story, and that is data centers. Electrical Solutions organic sales increased approximately 18%, with management pointing to strength in markets including data centers, light industrial, and non-residential construction. Again, I'm not going to turn all of that into AI revenue. We don't know exactly how much Hubbell's revenue is coming directly from AI data centers, but we do know that the company is benefiting from both sides of the electrical buildout: utility investment outside the data center and electrical investment inside the data center ecosystem. But there's another reason Hubbell deserves to be in this competition. It's not just growing. The economics of this business look very different from the contractors we just examined. Hubbell's utility solutions business produced an adjusted operating margin of roughly 25.6%. And that's a powerful number. When a contractor wins more work, it also has to mobilize more people and equipment and working capital to execute that work. Hubbell can participate in the same infrastructure boom by manufacturing and selling specialized products into those projects. And that gives us an entirely different investment profile. And this is what makes Hubbell so interesting. It doesn't need to predict which contractor wins every giant transmission project. If grid investment keeps rising, the equipment still has to be purchased. And if more substations are built, they need components. And if utilities modernize existing infrastructure, they need components as well. And if enormous data centers require additional electrical systems, those projects need equipment too. So now we have three different competitors. Quanta gives us enormous scale. MYR gives us a smaller company that could potentially grow into the opportunity. And Hubbell gives us a high margin equipment supplier. But before we start deciding which business model we like best, there's another test these companies got to pass, because infrastructure boom can consume enormous amounts of capital. Projects require equipment, and acquisitions require cash. Growth requires working capital. And if that electrical build out lasts for years, I want to know which company has the financial strength to keep taking advantage of it. So let's open the balance sheets. First, let's start with Quanta, PWR. Quanta finished the second quarter with approximately $506 million in cash and roughly $6.1 billion of long-term debt obligations, including current maturities. And that's a meaningful amount of leverage. But Quanta also generates an enormous amount of cash. Management expects somewhere between $2 to $2.5 billion of free cash flow in 2026. So I'm not looking at Quanta's debt immediately seeing a red flag. The company has substantial obligations, but it also has the cash generation machine needed to support them. Hubbell is a little different. Hubbell had approximately $375 million in cash at the end of quarter and roughly $5.37 billion of debt. But there's an important reason that number recently increased. Hubbell completed its roughly $3 billion acquisition of NSI Industries. So Hubbell has deliberately taken on additional leverage to expand the company. And that doesn't automatically make it a bad decision. If NSI produces the growth and synergies Hubbell expects, the acquisition could create substantial long term value. But it does mean Hubbell now has less balance sheet flexibility than it had before the transaction. And that's something we have to account for. Then we get to MYR Group, MYRG. At the end of the second quarter, MYR had approximately $138 million free cash flow and debt of only $9 million. That's essentially a near debt-free balance sheet. And MYR also had roughly $460 million of borrowing availability under its revolving credit facility. That gives a company with market capitalization under $5 billion a lot of flexibility, and it can invest in the business, and it can pursue acquisitions, it can deal with working capital swings, and it can potentially expand without starting from an already high leverage position. And now there's one number that could look concerning if we only glanced at that quarter. MYR's second quarter free cash flow was a negative by roughly $26 million. This is where context matters. Contracting businesses can experience significant working capital swings depending on project timing. And over the trailing 12 months, MYR generated roughly $193 million of positive free cash flow, as you see here. So I don't think the evidence supports calling MYR's negative quarter a structural cash flow problem. It's something to monitor. But right now, the larger balance sheet picture looks extremely strong. And that gives MYR our first clear advantage in this competition. Financial strength goes to MYR. Not because it generates more cash than Quanta, it does not, but because MYR enters this enormous infrastructure cycle with strong liquidity and almost zero debt. Quanta has the biggest cash engine. Hubbell has strong cash generation, but recently increased its leverage. MYR has the cleanest balance sheet, and that matters because we're not looking at a 6-month investment cycle. If AI power demand and grid modernization become a decade-long infrastructure buildout, financial flexibility could become a major competitive weapon. But money alone doesn't determine who wins, because if this opportunity is really as large as it appears, more competitors are going to want a piece of it. So the next question may be even more important. What stops somebody else from taking the work? And that's where we need to look at the moats. Who has the strongest competitive advantage? So we've established that all three companies can benefit if electrical infrastructure spending continues to accelerate. But whenever an industry starts attracting this much money, something else happens. And that is competition follows. If utilities are spending billions, and if data centers are creating massive new electrical loads, and if transmission and grid infrastructure become one of the biggest investment themes of the next decade, every contractor and equipment manufacturer is going to want a piece of it. And so now I want to ask a different question. What stops someone else from taking the business? And this is where Quanta size becomes much more than just a big revenue number. Quanta has approximately 70,000 employees. More importantly, the company says itself performs more than 85% of the work. And that matters because you can't suddenly decide tomorrow that you want to become one of America's largest high voltage infrastructure contractors. You need trained workers, you need specialized equipment, you need engineering capabilities, and you need a safety record. You need experience executing enormous projects where mistakes can be incredibly expensive. And the skilled workforce may be one of the most underappreciated pieces of Quanta's advantage. There's already tremendous demand for electricians, linemen, and other specialized workers. And if grid construction accelerates even further, that workforce becomes more valuable. And Quanta already has it. It also means Quanta can increasingly offer customers something extremely valuable. And Quanta already has it. It also means Quanta can increasingly offer customers something extremely valuable. One company capable of handling multiple parts of an enormous infrastructure project. Instead of a utility trying to coordinate a long list of contractors, Quanta can take responsibility for a much larger portion of the job. So for Quanta, the mode is scale, workforce, and execution. MYR's competitive advantage looks different than PWR or Quanta. It's obviously not going to be Quanta on sheer size. It doesn't necessarily have to. MYR operates through specialized electrical contractors with established positions in different regions and markets. And utility work isn't simply about finding whoever offers the lowest price. A utility needs to know the contractor to execute safely, that the contractor can execute safely, and that crews are going to show up, that deadlines can be met, and that the company understands the utility system. Those relationships can take years to build. MYR's acquisitions of Valley Electric and Comet Electric added more than just revenue. They added skilled workers, regional capabilities, and customer relationships that in some cases stretch back more than 20 years. So MYR's mode is less about dominating the entire industry and more about being deeply embedded in the market where it operates. Specialization, relationships, and regional expertise. And then we have Hubbell. And Hubbell may have the most interesting mode of the three because it isn't based primarily on labor. It's based on the products themselves. When utilities install critical electrical equipment, they don't necessarily choose a new supplier every time they start a project. These companies need to work. They need to meet specifications, and they need to survive for years in some of the harshest environments imaginable. And failure can be extremely expensive. So utilities qualify suppliers, engineers specify products, and contractors become familiar with equipment. And once a manufacturer becomes embedded inside that ecosystem, replacing it isn't always worth the risk. That creates something extremely valuable, and that is pricing power. Hubbell doesn't have to be the cheapest supplier if the customer already trusts the product and has designed it into the system. So Hubbell's moat comes from engineering, qualification, installed products, and customer trust. Three companies, very different competitive advantages. But if I have to give one company edge here, I'm going to give the moat advantage to Quanta. The combination of workforce scale and ability to execute enormous integrated projects is extremely difficult to replicate. And Hubbell is close because its products can become deeply embedded in utility systems. MYR absolutely has a mode, though, through expertise and relationships. But Quanta's infrastructure machine is operating at another level. And the question is whether that superior competitive position is enough to make Quanta the best investment. Because having a great moat does not eliminate the risk. All right, so what are the risks investing in these companies? First, let's start with Quanta, PWR. Quanta's biggest risk may actually be its own success. The company has become one of the most obvious ways for investors to play the electrical infrastructure boom, and that means expectations are enormous. When investors expect extraordinary growth, simply delivering good results may not be enough. And Quanta is taking on increasingly large and complicated projects. The bigger the project, the larger the consequences of execution slips. Costs can rise, schedules can move, margins can get squeezed. Quanta has also expanded through acquisitions, which adds integration risk. And as we saw in the last chapter, this isn't a company operating with MYR's almost debt-free balance sheet. None of those things destroys the Quanta's thesis, but they can increase the consequences of disappointment. And for Quanta, the risk is that investors begin treating extraordinary execution as normal. And once perfection becomes the expectation, there's not much room for mistakes. MYR has almost the opposite problem. Its smaller size is one of the reasons the stock is so interesting. But smaller size also creates risks. A project problem that might barely move Quanta's overall results could matter much more for MYR. Contractors also have to manage working capital carefully. and they may spend money on labor and equipment before receiving payment from customers. And that's one reason quarterly cash flow can bounce around. And construction contracting is not a 25% operating margin business like Hubbell's utility solutions operation. Execution matters enormously. If MYR bids a project incorrectly or labor costs rise faster than expected, margins can get squeezed quickly. And so the same thing that gives MYR potential upside is its smaller size. Also, it gives less room for error. And then we have Hubbell. Hubbell, one of the biggest near-term questions is the NSI Industries acquisition. Hubbell spent roughly $3 billion on that transaction. And as we already saw, leverage increased significantly afterwards. So now management has to prove the acquisition was worth it. Can Hubbell integrate NSI successfully? Can it generate the expected growth? And can it produce enough cash to bring leverage back down? If the answer is yes, today's higher debt could eventually look like a smart use of capital. And if the answer is no, Hubbell paid a lot of money and reduced its financial flexibility at exactly the moment investors are expecting strong execution. Hubbell also isn't completely insulated from the broader economy. Some of the electrical businesses have exposure to residential, commercial, and industrial construction. Grid spending may remain strong while another part of the business slows. And when there's the risk that all three, and then there's the risk all three companies share. What if the AI electricity boom takes longer than everyone expects, where projects can get delayed? And plus, America still needs electrical infrastructure, but some of the urgency currently being priced into these companies could change, and that's an important distinction. A great long-term industry can still produce an overpriced stock, which brings us to the part of this competition I've deliberately saved almost till the end. So now let's look at the valuation, because I didn't want us looking at these companies through the lens of their stock prices before we understood the business. We now know what each company brings to the table. So let's look at what investors are being asked to pay. Quanta Services are trading roughly at around 70 times trailing earnings. MYR Group is around 29 times earnings, and Hubbell's around 28 times earnings. And that completely changes this competition because MYR and Hubbell are essentially trading at the same earnings multiple. The real outlier is Quanta. Investors are currently willing to pay roughly 2.5 times earnings multiple for PWR compared to the other two companies. And there's a reason for that. Quanta has earned a premium. We've seen the scale of the opportunity it's capturing, and we've seen its ability to execute massive projects. And we've seen why its competitive position is so difficult to replicate. So I'm not saying Quanta should trade at the same valuation as MYR or Hubbell. The question is, how much of a premium is too much? Because when you're paying around 70 times trailing earnings, you're not simply betting the company continues doing well. You're betting that extraordinary growth continues, and you're betting the execution remains strong. And this is where MYR gets interesting again. MYR is only trading around 29 times earnings, and that's not cheap in an absolute sense, but we're looking at a company worth less than $5 billion participating in potentially enormous infrastructure cycle. So with MYR, we're getting a very different combination. Smaller starting point, strong growth, much lower valuation than Quanta, and the financial flexibility we saw earlier. And then there is Hubbell trading at roughly 28 times earnings. Hubbell costs them exactly the same earnings multiple as MYR, but the investment position is completely different. MYR gives us more of a smaller company growth opportunity. Hubbell gives us the equipment business with stronger margins, established products, and potentially more stable economics. So if you're choosing between those two at approximately the same multiple, the question becomes, do you want MYR's growth potential or Hubbell's quality and margins? And that's a much harder decision than I expected when we started the stock hunt, because I think Quanta may be the best company of the three, but that doesn't automatically make PWR the best stock at today's price. And that's exactly why we have the AI Factory Scoreboard. So it's time to put all 7 categories together. All right, we've reached the scoreboard, and this one's close, starting with AI grid exposure. I'm going to give Quanta a 9.5 out of 10. MYR gets an 8.5, Hubbell gets a 9. For growth, we got 9.5 for power, 9 for MYR, and 8.5 for Hubbell. Demand visibility gets a 10 from PWR, 8.5 for MYR, and Hubbell gets 8.5. The competitive moat is a 9.5 for PWR, an 8 for MYR, and a 9 for Hubbell. And the financial strength of the company, PWR gets an 8, MYR gets a 9.5 for very little debt, and Hubbell gets the 7.5. And then comes the valuation. This is where Quanta takes the biggest hit. I'm going to give PWR 5.5, not because the business isn't excellent, but because at around 70 times trailing earnings, investors are already paying a massive premium for that excellence. MYR gets an 8.5, and so does Hubbell. Finally, the upside potential. Quanta gets a 7.5. Hubbell gets a 7.5. And MYR is starting from such a dramatically smaller base. I'm going to give it a 9.0 out of 10. Now let's apply the weights. Quanta Services finishes with an 8.5 out of 10, or an 8.55, or the final weighted score is 8.63 out of 10. Hubbell finishes with an 8.48 out of 10. And our winner is by only 2/10 of a point, and that is MYRG at 8.65 out of 10. MYR is today's AI Factory champion. I did not expect that when we started the comparison. And if you ask me which company here has the strongest overall infrastructure business, I would probably still say Quanta Services. Quanta is an absolute machine, but this isn't simply a competition to find the biggest or best company. We're looking for the best combination of business quality, exposure to the opportunity, and financial strength, valuation, and potential upside. And that's where MYR barely gets the win. MYR gives us exposure to transmission and distribution infrastructure. It also gives us exposure to commercial and mission critical projects. It enters the cycle with extremely clean balance sheet and at roughly the same earnings multiple as Hubbell and dramatically below Quanta. I think MYR gives us the most interesting combination of growth and potential upside. But look at these final scores. MYR 8.65, Quanta 8.55, and Hubbell 8.55. That's about as close to the AI Factory competition can get. And I actually think that's appropriate because I can make a legitimate investment case for all three companies. And if you want the dominant infrastructure leader, it's Quanta. If you want the high margin picks and shovel supplier, it is Hubbell. But if you want the smaller company that could potentially have more room to grow into the massive electrical infrastructure cycle, today's AI Factory champion is MYR Group. And here's the important part. Winning the AI Factory does not automatically mean that I'm buying the stock. And that's what Friday Fun Hunt is for. We now have our Wednesday champion. And on Friday, we're going to put MYR through a completely different test. We're going to look at the stock from the perspective of our $100,000 hypothetical fund and decide whether today's AI Factory winner actually deserves our money. So make sure you come back for Friday Fun Hunt to find out whether MYR actually gets added to the portfolio. And I recommend subscribing so when the video is released, you'll see it first. And if you want to support the channel, get access to my Stock Hunt Insider Notes. You can become a member at buymeacoffee.com/20-minute stock hunt. If you're enjoying the stock hunt, make sure to like this video and subscribe so you don't miss the next one. We've followed another constraint. We've found another AI Factory champion. And now we got to decide if we're actually willing to buy it. So we'll see you on Friday for Friday Fun Hunt. See you in the next one.